In 1994, a financial planner sat down with a spreadsheet and produced a single number. 3 decades later, that number quietly decides when millions of people believe they are allowed to stop working. He never called it a rule. And depending on which researcher you ask today, it is either dangerously too high or quietly far too low. This is the 4% rule. The full story. Chapter 1. The Engineer and the Spreadsheet. William Bengen was not an economist. He was trained as an engineer, spent years running a family business, and only came to financial planning in middle age. That outsider's habit of mind turned out to matter. When clients asked him the most basic question in retirement, how much can I take out each year without running out? He discovered that the profession had no rigorous answer. Advisors were quoting 5%, sometimes 6%, based on little more than the long-run average return of stocks. Bengen found that reasoning suspicious. Averages, he knew from engineering, are a poor guide to whether a structure survives its worst day. So he built a simulation. He took market data stretching back to 1926, pairing large American stocks with intermediate-term government bonds in a portfolio split evenly between the two, rebalanced every year. Then he imagined a retiree starting in each of those years. That retiree withdraws a fixed percentage in year 1, and every year after that takes the same amount again, adjusted upward for inflation. The question was mechanical. Roll that portfolio forward for 30 years through every real sequence of booms and crashes the historical record contains, and see which starting percentage never once emptied the account. The answer was 4.15%. Bengen called it the SAFEMAX, the largest withdrawal rate that survived even the single worst starting year in his data. That worst year sits in the middle of the 1960s. Those sources still disagree on the exact one. Bengen's own illustration follows a retiree who stopped working in 1968 and walked straight into a decade of stagflation. Later recalculations of his method point to 1966. Either way, the point stands. 4.15 was not the typical outcome. It was the number that survived catastrophe. Bengen rounded it down and called it 4. Chapter 2. How a study became a law. 4 years later, 3 finance professors at Trinity University in San Antonio, Texas, went looking for the same answer with different tools. Philip Cooley, Carl Hubbard, and Daniel Walls published their results in the AA Journal in February 1998. Rather than hunting for a single worst case, they measured success rates. They ran every overlapping 15, 20, 25, and 30-year window between 1926 and 1995 and asked a simpler question. Out of all those historical retirements, what fraction of them survived at each withdrawal rate? The results were tidy enough to become famous. A portfolio holding half stocks or 3/4 stocks, drawing 4% adjusted for inflation, survived somewhere between 95 and 100% of the 30-year windows they tested. Push the rate to 5% and success fell to roughly 83%. At 6% it dropped to about 68%. 1 in 3 retirees, in other words, would have run dry. The authors updated the work in 2011, extending the data through 2009. Their conclusion barely moved. Somewhere between the academic journals and the internet, the finding mutated. A conditional research result, 4%, held up in this particular data set under these particular assumptions, hardened into a commandment. It also acquired a mirror image. If you can safely withdraw 4%, then the pile you need is 25 times your annual spending. That single sentence became the arithmetic backbone of the early retirement movement. People began measuring their lives against it, counting down to a multiple. A cautious footnote about the 1960s had become a finish line. Chapter 4. The assumptions nobody repeats. Every number carries its assumptions the way a bridge carries its load rating. Strip the assumptions away and the number means nothing at all. Bengen's simulation ran for exactly 30 years, because 30 years was a reasonable guess for a 65-year-old in 1994. It says nothing about a person who retires at 45 and needs the money to last 50 years. It says nothing about someone who retires at 75. The 30-year horizon was not a discovery about markets. It was a design choice, borrowed from actuarial tables and quietly inherited by everyone who repeated the answer. The simulation also charged no fees. No advisor taking 1% of assets each year, no fund expenses, no trading costs. That omission is larger than it sounds. A 1% annual fee on a portfolio funding a 4% withdrawal is not a small trim. It consumes roughly a quarter of everything the retiree was supposed to be living on. And it charged no taxes either. 4% drawn from a traditional retirement account is 4% before the government takes its share. The number that gets quoted is gross. Nobody lives on gross. Then there is the retiree at the center of the model, who is not a person but a machine. She withdraws precisely the same inflation-adjusted sum every single year for 3 decades. Markets collapse by 40% and she takes her raise anyway. Markets triple and she refuses to spend $1 more. No real household behaves like this. Every actual retiree tightens up in a bad year, splurges after a good one, and stops flying to Europe at 85. The rigidity that makes the model tractable is exactly what makes it unrealistic. The deepest assumption is the quietest one. All of this ran on the market history of a single country across a single century, and it deliberately targeted the worst moment in that history. Bengen was not predicting your retirement. He was stress testing a structure against the largest earthquake in the records he had. The 4% rule was never a forecast of what will happen. It was a floor, calibrated to what already did happen, once, in one place. Everything that follows in this video is an argument about whether that floor is in the right room. Before we move on to the next chapter, if you're enjoying this, please like the video, follow so you don't miss future videos, and turn on notifications. Chapter 4. The case that 4 is too high. Start with the mechanism that makes retirement mathematically different from saving. It is called sequence of returns risk. Imagine 2 retirees with identical portfolios earning the identical average return over 30 years. The only difference is the order of those returns. The first retiree gets her crash in year 28, after decades of compounding have built a cushion she can absorb it with. The second gets his crash in year 2, and every withdrawal he makes afterward is selling more shares at a lower price, permanently removing them from the recovery. Same average, same portfolio. One dies wealthy, one dies broke. In June 2013, 3 researchers pressed on exactly this weakness. Michael Fink, Wade Fall, and David Blanchett published a paper in the Journal of Financial Planning with a title that left little room for negotiation. The 4% rule is not safe in a low-yield world. Run the standard simulation on long-run historical averages. They showed, and 4% fails around 6% of the time. That is the comforting number everybody knew. Then they changed one input, and only one. They recalibrated bond returns to the real yields, actually available in January 2013, when inflation-protected treasuries were paying close to nothing, while leaving the historical equity premium fully intact. The projected failure rate for a 4% withdrawal jumped from 6% to 57%. More than half of simulated retirees ran out of money. Their recommendation was blunt. Under those conditions, a prudent retiree should not withdraw more than 3%. One assumption moved, and a rule that felt like arithmetic revealed itself as a conditional forecast. The most uncomfortable challenge came later, and it questioned the data itself. Asa Nakulova, Scott Sederberg, Michael O'Doherty, and Richard Cias assembled asset returns across 38 developed countries and asked what a safe rate looks like when the United States is not the only country in the sample. Their answer was brutal. A 65-year-old couple willing to accept a 5% chance of running out could withdraw about 2.3% per year. Their working paper puts it at 2.26. The published version says 2.31. Neither is anywhere near 4. The same study estimated what the 4% rule would actually have delivered across that broader history. A retired couple following it faced roughly a 17% chance of exhausting their savings before they die. Nearly one retirement in 6 ends with the money gone and the life still running. Their argument is not that America was lucky by accident. It is that the 20th century United States was the single most successful capital market in recorded history. And building your retirement on its returns is a bit like studying only the lottery winners to learn about the odds. Chapter 4. The case that 4 is too low. Now turn the telescope around. Because the 4% rule was engineered to survive the worst case, it is almost by definition far too cautious in every other case. The financial planning researcher Michael Kitces measured what actually happened to the historical retirees who followed it. In more than 2/3 of 30-year periods, the retiree finished with more than double the money she started with in real inflation-adjusted terms. The median ending balance was roughly 2.8 times the original portfolio. About one retirement in 6 ended with more than 5 times the starting principal. Read that again because it describes a failure mode nobody warns you about. The typical follower of the 4% rule does not run out of money. She dies with nearly 3 times what she retired with, having spent 30 years denying herself trips, gifts, and comfort in order to insure against the 1960s that never came. The rule protects against ruin with real effectiveness. It also, in the overwhelming majority of outcomes, quietly converts a life into an inheritance. That is not a neutral outcome. It is a cost paid in the years you had left. David Blanchett attacked the other unrealistic assumption, the robot who spends identically forever. Studying how retirees actually spend, he found real spending does not climb with inflation at all. It declines by roughly 1% a year on average. The pattern he mapped has a shape people now call the retirement spending smile. Expenditure runs high in the early healthy, traveling years, sags through a long quiet middle, and lifts again at the end as medical costs arrive. Model that curve honestly, and initial spending can be around 20% higher than the flat assumption allows. And then, in August 2025, the most authoritative voice in the argument changed his own mind in public. Bengen published a book called A Richer Retirement, and it is essentially an apology for his own conservatism, widening the portfolio to 7 asset classes, adding American mid-cap, small-cap and micro-cap stocks, international equities, and treasury bills to his original 2 holdings. He found the historical worst case had never been as bad as he thought. The SAFEMAX rose from 4.15% to 4.7%. He went further. For retirees today, Bengen now suggests something close to 5% as a sensible starting point, and 5.25% to 5.5% for those with flexibility in their spending. The subtitle of the book is Supercharging the 4% Rule to Spend More and Enjoy More. The man whose research built the cage spent the last 30 years watching people lock themselves inside it and wrote a book asking them to come out. Most retirees who rigidly held to 4%, he argues, were living on less than they safely could. Chapters. Your number is not a number. If you want proof that the safe rate is not a constant of nature, watch a serious institution try to publish it every year. Morningstar has done exactly that. Its first study in 2021 landed on 3.3%. The following year it rose to 3.8%, then 4.0%. Then it fell back to 3.7%. Its 2025 research puts the figure at 3.9% for a 30-year retirement, a 90% success target, and a portfolio holding somewhere between 30 and 50% stocks. That figure moved by more than half a percentage point in 4 years, and markets were not the only reason. Bond yields changed. Valuation levels changed. The assumptions changed. The lesson is not that Morningstar is unreliable. The lesson is that the safe withdrawal rate is a function, not a fact. Feed it a different horizon, a different fee load, a different bond market, a different country, and it returns a different answer every time, exactly as it is supposed to, which points toward what actually matters. Your horizon is the largest single input, and it is not 30 years for everyone. Retire at 45 and you are asking a 30-year model to cover 50. Your fees are the second. Every fraction of a percent you pay is subtracted directly from the rate you can sustain, and your flexibility is the third, and it is the most powerful of all. A retiree who can skip the inflation raise after a bad year or trim spending by 10% for 2 years is running a fundamentally different and far more survivable experiment than the machine in the simulation. So here is the reframe. The 4% rule is a fire drill, not a weather forecast. It tells you what a portfolio could have endured in the worst conditions on record, in one country, under one rigid set of behaviors, with no fees and no taxes. It was never designed to tell you what your life will cost or how long you will live. Bengen built a stress test. An industry sold it as a promise, and a generation of savers mistook the safety margin for the target. That the uncomfortable truth is that nobody can hand you your retirement number, because the number does not exist independently of the assumptions you feed it. What the last 30 years of research actually offer is better questions. How long do I need this to last? What am I paying in fees? How much can I cut in a bad year, and how quickly? Answer those honestly and the percentage takes care of itself. Treat 4 as a law of nature, and you will either run out of money or run out of years to spend it. Money has rules, and most people never learn them. Follow algorithm of money and start decoding yours.